All right, for more market analysis, we're joined right now by Kristina Hooper, Chief Global Market Strategist over at Invesco. Kristina, great to have you here. I want to start off with yesterday and the Fed and a lot of the concerns that seem to crop up in the markets, in equity markets, about the messaging we got out of the Fed. The messaging that I got out of the Fed was that basically they had hit a floor under risk assets through 2023. That doesn't seem to be how the markets are interpreting it.
Well, that's the message I got, too. What I heard loud and clear is that the punch bowl is going to be out for several years. And that's not the reaction we've seen. Some have pointed to the fact that the Fed did also come out and say the economic outlook is very uncertain. That is not a surprise. That shouldn't be a surprise. We know that there are so many factors at play impacting the outlook going forward. We've got infections, development of therapies and a vaccine, stringency measures, fiscal stimulus, monetary stimulus. So that's to be expected. But the key message is, yes, that punch bowl was out for a long time.
It feels as though sometimes the markets just want to go lower. They want to find a reason to feel a little bit negative. And do you take some hope from underneath the surface, the reorientation that's sort of going on, the bid that we're seeing to a certain extent for small caps and the industrials? Is this going to give the market breadth, Kristina?
Yes, I think that is the silver lining of this, is that is giving the market breadth. We're seeing a rotation. Investors are not fleeing equities altogether. It does seem a bit premature, just given the timeline for a vaccine and given the fact that, of course, Jay Powell has talked about the vulnerabilities to the economy. But it's good to see investors staying, for the most part, in equities.
Yeah, we are seeing investors stay in equities. Kristina Hooper, Invesco Chief Market Strategist, going to continue that conversation with her in a moment. But Taylor, pick up on what Kristina was talking about here, because we have gotten a few sentiment indicators that seem to suggest that while folks are overly bearish, there are still people who are committed to what they think is going to be a rally.
Yeah, especially if they think that the punch bowl isn't going anywhere, the way Kristina had alluded. And we do that with the AAII Bull Index, and there's the AAII Bear Index. But at least for now, the reading this morning showed bulls are back. They rose 8 points to 32, giving back all that was lost in the prior 2 weeks. And bears also fell by 8 points, giving back all of their gains the prior 2 weeks. So you are seeing more bulls out there relative to bears. And we'll get some more of these other sentiment readings again tomorrow as well. More broadly, Romaine, we have been speaking about value winning the battle while growth is still winning the war. You are getting a little bit of a rotation. I'm taking a look at shares from my stock of the hour, GE. Certainly that value player industrial space getting a big win today. Up now for 2 straight days, the highest going back since July 22nd. This is after their CEO, Larry Culp, saying that they are looking at positive industrial free cash flow for the second half of the year. Key markets, according to him, are stabilizing. GE is making good progress in not only cutting costs and getting through this pandemic, but getting through a gradual recovery, releasing results that are improving. So if you're looking at GE, other industrials as a bellwether, positive industrial free cash flow, something that investors are happy about. And so we do that for the stock of the hour. I want to get back to a broader theme, Romaine, that you had mentioned, really talking about at the Fed yesterday. Kristina, let me pull you back in on this conversation. We're taking a look at a chart here of break-evens, 2s, 5s, and 10s. We'd started to see an improvement, but frankly, we're kind of all rolling back over again, anywhere between 1.5% to 1.8%. Are break-evens a good indicator of your inflation expectations? Do we have confidence that we can get there, or is this all just a moot point?
Well, that is a great question, and inflation is on the minds of a lot of investors. I do think we could expect inflation to get nudged up over time to the level that the Fed is predicting or projecting for the end of 2023, where we're getting up finally to the target. But it's going to take time, and I'm not too concerned about inflation rising well above it. I think this is an environment where there are so many pressures being placed that we're not going to see any kind of significant inflation anytime soon.
It's interesting that today we've had another day of dollar weakness. And on the back of that, we've also, though, had, amid the caution in the market, emerging market weakness as well. We've got terminal user sending in their question for you, Kristina, asking about your outlook for emerging market assets. Are you bullish there, or do you feel that the downward trajectory of the dollar will eventually sustain some buying?
Well, what I would say is that I'm a qualified bull there. I think there are particular areas of emerging markets that I'm positive on, and in particular, Asia EM. That's where I see the opportunity. That's where I see the growth. That's where I also see the ability to really control the pandemic and manage it very well. So certainly having a weaker dollar will be supportive of that, but those other elements are important, and that's why I'm focused on Asia EM.